All right, what's happening in today's video? I'm going to walk you guys through exactly how you can take a 401k and you can convert it to Roth in a way that is going to be most efficient for you long term. So the common issue that people have is they have all of this money inside of a 401k. Now the 401k, remember, is something that is pre-tax. And because it's pre-tax, when you take the money out of the 401k, you're going to pay tax. So let's take a basic example. Let's say somebody has $1 million in their 401k and they want to withdraw $100,000. Let's just assume they're after 59 years old or 59 and a half. So this is not going to have a penalty associated with it. But the $100,000 that comes out, one of the things that's going to happen is you're going to have federal tax on it. Now we could talk about states as well, but let's just talk about federal tax. Let's assume you had no additional income or maybe some additional income and you effectively pay a 25% rate when you take this out. So you're left with 100 minus 25, which is 75K. Now that's great because you have the money. You did not pay the penalty because it was after 59 and a half, but you effectively lost $25,000. That's not great. So how can we create it in a way that we can get this money into a Roth or take it out without a problem? Remember that a Roth product is after tax. So if I take a 401k and I move it to a Roth 401k, this is taxable. Totally taxable. Because you've converted it to an after-tax product. Because when you take the money out here, it is going to be tax-free. The best way, or one of the best ways to get the money out here, is you have to look at your income minus your expenses and get negative $100,000. Because if you had negative $100,000 and you did the Roth conversion, this would allow you to add $100K to your income in that example above. If I'm negative 100 and I add 100, I'm at zero, which means that in that particular year, I don't have any tax on this. So what a lot of people will do, or I shouldn't even say a lot of people, what some people will do that are trying to build this strategy is they will go earn an income. Let's say their income is $250,000 for the year. And let's say that they buy a $1.5 million asset. And let's just say, for the sake of this argument, let's just say this person has real estate professional status and they're going to get a cost segregation. Remember, a cost segregation is going to allow you to depreciate an accelerated amount of this $1.5 million. Let's just say 33%, which means you can write off $500,000. Remember that this is a tax deferral strategy, and is not a tax elimination strategy. All you're doing is writing this off now. So you get the cost segregation on the $1.5 million asset, and it comes out to $500K. When the $500K is there, you're going to have this as negative income. So you're going to have $250 come in minus the $500K, and you're going to be left with negative $250,000. In that particular year, the tax on this, you can't go get a rebate for this. It's just negative money that carries over to the next year. You can roll over your $100,000 from the 401k to the Roth 401k. And when you do this, that will add $100,000, which means you are now negative $150K. So you did the rollover, which is great. The 100K is added on, and you still have zero income. Now, this strategy works really well. Remember that if you take something out earlier than 59 and a half, there's a penalty. So you don't want to have that. But most of the people who've accumulated a large amount of wealth start doing this planning. Now, one of the things that is important to keep in mind is that over time, if we have time here and we have the investment in 401ks here, they always grow. Obviously, it goes up and down and has kind of this wiggle, but they always grow. And the problem is that you're growing income that is not tax-free because it's a 401k. So when you have all this liquidity up here, you get to $5 million or whatever the portfolio is. That's great, but you're going to have to pay a lot of tax as you start taking this out. So converting the seed, call this converting the seed, allows you to get tax-free up front, and then when it grows to $5 million, you can take all of it without any problem. The easiest way to do this is through offsetting the income and expenses. The best way to do this, or the easiest way to do this, is typically through depreciation and net operating losses. Depreciation comes from real estate, equipment, and vehicles. These things together will allow you to create depreciation, which will lower your income by creating expenses, creating negative income for you. If you create the negative income, it's not taxed. Very, very important strategy that you got to keep in mind. You got to make sure you can put this together, and you got to add this into your kind of general strategy. Now, in years where you maybe have really high income, let's say you have 500K, what a lot of people will do is they will do a 401K to lower this amount by, let's say, $43,000 or whatever the max is for the year in which you're in. And now your income has gone down by this amount. So you can plan from year to year, do I want to reduce my income? If the answer is yes, I can contribute to the 401k. If I want to convert this, I need depreciation or some other kind of net operating loss or some type of expense that will offset it so that this can come out tax-free. This is a totally legal strategy. This is something that you can plan around, and this is something that can work for most people. Real estate, obviously, like anything else, has some risk. So when you buy an asset, you're going to have income and expenses, and hopefully you have cash flow positive, but there are times where you don't have cash flow positive. Very, very important. If you want to learn more of these types of strategies, this is something that I'll start showing a little bit more activity on so you guys can learn how this process works, and hopefully you can follow this along. Keep in mind, very, very important, compliance. Compliance is one of the most important things. You must document everything. You must work with a proper tax advisor. You must work with people that know how to do this, and also potentially look at your financial advisor and ask them how to do some of these strategies, because the 401k rollover strategy is not just a tax component, it's also a wealth component. And you have to put all these together in order for it to work for you. In another video, I will show you how you can use depreciation from other things like vehicles, and we can talk about Section 179, which currently has a 1.22 million in depreciation limit, which can be very helpful if you're trying to create lower than typical income, but you can't go negative. So hopefully that helps. If you have questions, drop them in the comments, and we'll see you in the next video.